Today, I sold half of one of my largest positions. But before I say which stock and why, you need to understand what rattled the markets today and why they took a tumble. The S&P 500 fell 1.6%, the Dow Jones got hit 1.9%, and the NASDAQ fell 1.4% in today's trading. Okay, let's break this down. So, a Moody's downgrade yesterday really tampered the tone of the markets and started us off in the red, but then we ended up recovering, finishing yesterday in the green, helped by a Google I/O event. Today, not so lucky. We ended up finishing down off of a weak 20-year Treasury yield as concerns about our US physical debt are starting to rise. So what is a US Treasury auction anyway? Today, the US did an auction for 20-year Treasury bonds, raising $16 billion. Bonds are just essentially an IOU to the government. You lend them cash now, they'll give you yield payments over the next 20 years and give you your money back at the end of it. So what happened at today's auction that sparked the market to sell off and got investors concerned? First, there was low demand for this auction, which is measured by the bid to cover, which came in at 2.46 times versus the 6-month average of 2.57 times. Second, higher yield was demanded just to lure investors in, and the yield for the 20-year Treasury actually topped 5% for the first time since November of 2020. And third and finally, a little bit more of a nuanced one, the tail and non-dealer bid. The tail came in above expectations and positive, essentially just meaning that the yield going into the auction ended up being higher at the end of it, showing weak demand and again a need for a higher yield to lure investors. And the non-dealer uptake also came in below estimates at around 83%, which roughly is around 85%. Non-dealers are essentially anything outside of big banks paying into these treasuries. These are both signs that investors really weren't lining up for this treasury, and again tying back to physical concerns and US government debt. So in short, fewer buyers means that the Treasury had to offer more interest, raising yields higher. So why do the higher yields send stocks into a tailspin? Higher yields make fixed income more attractive than riskier assets such as stocks, causing investors to sell off their stocks, especially riskier stocks such as high growth stocks. Cost of capital also rises, anything from mortgage rates to corporate debt, meaning everything essentially gets pricier when longer term yields climb. And finally, due to this, there's a profit squeeze as companies have to pay more in order to borrow. This typically reduces the incentive for a company to continue to pursue high growth, such as opening up a new factory or starting a new big project. Profit squeeze. Companies are forced to pay more to borrow, so this disincentivizes them for higher growth projects, such as buying a new factory, and it also trims their profits. But these yield spikes don't just happen in a vacuum, they really reflect a key issue of our US debt, and investors are starting to get worried. Our total US debt is over $36 trillion, and 2025 deficit projection is to $1.9 trillion this year, up from $1.7 trillion last year. There's also a large tax bill impact that could raise this deficit and debt even further. The new big beautiful bill could add up to $3.1 trillion more to our debt over the next decade. And then came Moody's, cutting the American credit rating from AAA down to AA1. This is the first time in 80 years that the US credit has been downgraded. Why is this? Why did they downgrade the US? Again, due to these chronic deficits and no clear plan for us to get out of the hole or really pay back our debts. Which brings me to the downgrade I did today in my portfolio, selling half my position in Microsoft. Why? As I noted in my last video, Microsoft is approaching resistance levels and they're trading at a historically high price to earnings ratio. I also didn't really like the price action I saw today as the NASDAQ turned up and stocks such as Google had a big run. Microsoft lagged behind and continued to get stuck over the past 5 days at these key resistance levels. I also think the market in general right now, the risk to reward is really skewed to the downside as there's still large amounts of uncertainty within the general market. And we've also rallied back hard from where we were previously before Liberation Day. And I think the S&P 500 is about to get caught up in some serious resistance around that 6,000 level or its previous all-time highs. I say this because stocks are historically expensive as they're currently trading at 21.5 forward PE, which is based on next year's earnings, versus the 10-year average of about 18.5, marking 10% downside just if we correct back to those levels. So based on this potential for a pullback, the cash that I'm receiving from Microsoft, I'll now have to deploy if we do get that pullback or correction based on valuations within the market. So this is now where you do your research and you get your watch list together as you eye in on some potential stocks to put that new money to work. Let me know in the comments what stocks you have your eye on and how you're currently positioning your portfolio. And as always, like and subscribe to stay up to date for more.